Once hailed as a promising emerging market, how did Pakistan find itself on the brink of economic collapse? In the early 2000s, Pakistan's economic narrative was marked by optimism and growth. The country experienced robust growth rates, with its GDP soaring thanks to significant advancements in key sectors like textiles and agriculture. Textiles, being the backbone of Pakistan's economy, attracted heavy foreign investments which propelled the industry forward. Agriculture also saw modernization efforts that increased productivity and exports. This era was further enhanced by favorable policy decisions. The government introduced reforms that liberalized the economy, reduced trade barriers, and encouraged private sector involvement. These changes created a fertile ground for both local and international businesses to thrive. Moreover, international aid played a pivotal role in this economic upsurge. Financial assistance from global institutions and bilateral partners not only helped in stabilizing the economy, but also funded various development projects across the country. This influx of aid was a testament to the confidence the international community had in Pakistan's economic policies and its future prospects. However, while the economy was expanding and diversifying, certain critical issues were simmering beneath the surface. These issues, largely overlooked in the wake of immediate economic gains, would soon prompt a series of economic challenges. From a booming economy to the onset of challenges, Pakistan's journey was about to take a dramatic turn. How does political turmoil translate into economic hardship? In Pakistan, the tale is vividly illustrated by the frequent changes in government from the mid-2000s onward. This period was marked by a carousel of leadership, with no single party or leader maintaining a firm grip on power for long. Each change brought with it a new set of economic policies, often contradicting or overturning those of the previous administration. Consider, for instance, the shifts in tax policy. One administration might introduce stringent tax measures to curb deficits, only for the next to roll these back in an attempt to stimulate growth. Such reversals make it challenging for businesses to plan for the future, leading to reduced investment and stunted economic growth. Moreover, political instability can spook investors, both domestic and international. When the future political landscape is unpredictable, the risks associated with long-term investments increase. Investors, rather than risking their capital in an unstable environment, look for safer havens. This flight of capital deprives the country of crucial investments needed for large-scale projects and infrastructure development, which are vital for economic growth. Additionally, frequent government changes often lead to disruptions in foreign aid and international economic agreements. Partners and allies may hesitate to engage deeply, unsure of whether the current government will honor commitments made by its predecessors. With the political ground ever shifting, economic policies lacked the consistency needed for long-term growth. Borrowing today for a better tomorrow, but at what cost? In the labyrinth of Pakistan's economic narrative, the chapter on debt is particularly telling. Over the years, the government's strategy has hinged on borrowing, both from domestic sources and international markets. This move, ostensibly aimed at financing development and infrastructure projects, seemed a plausible path toward economic prosperity. However, the reality unfolded differently. The accumulation of external debt is a story of entanglement with international lenders. These entities, including the International Monetary Fund and the World Bank, extended financial support with strings attached. These conditions often mandated stringent fiscal adjustments, which, although designed to stabilize the economy, frequently led to short-term hardships for the population. Domestically, the government issued bonds and took loans from local banks. This internal borrowing might seem less daunting than its external counterpart, but it carries its own set of challenges. It competes with the private sector for funds, often leading to higher interest rates and crowding out private investment, which is crucial for economic growth. As the debts piled up, so did the interest obligations. By the late 2010s, a significant portion of the government's revenue was earmarked not for development, but for debt servicing. This scenario created a precarious cycle. Borrow to pay off past loans while simultaneously accruing new debts. It's a financial treadmill that's hard to stop once it's in motion. Moreover, the high interest rates on these loans have had a stifling effect on economic growth. The cost of borrowing became increasingly unsustainable, and the intended benefits of these loans, like infrastructure development and economic reform, were often lost in the quagmire of immediate fiscal pressures. The role of international lenders was double-edged. While their financial assistance provided necessary relief in times of crisis, the attached conditions and the subsequent debt servicing created a dependency trap. This dependency sapped fiscal autonomy and left the economy vulnerable to external shocks. As debts mounted, the financial burden began to suffocate Pakistan's economy. No country is an island, especially not in today's globalized economy. Throughout its history, Pakistan has been significantly impacted by an array of external factors, each weaving a complex tapestry of economic challenges. Let's consider the global financial crisis of 2008, a seismic event that reverberated across the world's economies. Pakistan, with its budding financial sectors, was not spared. The crisis led to a steep decline in investment flows into the country, as global investors battened down the hatches, retracting funds from markets they perceived as risky. This reduction in investment was a significant blow to Pakistan's economic growth, which had been heavily reliant on foreign capital to fund development projects. Moving beyond the crisis, changes in global trade policies have also played a pivotal role. As major economies engaged in trade wars and protectionism, countries like Pakistan found themselves at a disadvantage. The shifts towards more restrictive trade policies curtailed Pakistan's export opportunities, particularly in textiles, which is a cornerstone of its economy. This resulted in reduced foreign exchange earnings, further straining the economic landscape. Fluctuating commodity prices have been another critical factor. Pakistan, a major importer of oil, has often been at the mercy of volatile oil prices. When prices soar, the cost of imports spikes, leading to increased trade deficits and putting pressure on foreign reserves. Each of these external shocks tested Pakistan's economic resilience, revealing underlying weaknesses. When mismanagement and corruption seep into an economy, the consequences can be dire. In Pakistan, the tendrils of corruption have not just lightly brushed the economy, but have taken a firm grasp. This corruption manifests not only in grand scandals, but also in the day-to-day inefficiencies and mismanagement that have collectively undermined the nation's economic stability. Take, for instance, the power sector. Plagued by mismanagement, the sector has seen billions of dollars disappear into the black hole of inefficiency and corruption. Projects that should have bolstered Pakistan's energy infrastructure turned into costly misadventures, with funds allocated for development mysteriously vanishing. The result? Persistent power outages that cripple businesses and deter foreign investors. Similarly, in the realm of public procurement, the lack of transparency and accountability has led to contracts being awarded to favored companies, often at inflated costs. These contracts, shrouded in secrecy, frequently result in subpar outcomes and unmet targets. Such practices not only waste public funds, but also discourage honest businesses from participating in the economic system, fearing it's rigged against those who don't pay to play. Moreover, the impact of these corrupt practices extends beyond financial loss. They erode public trust in governmental and financial institutions. When citizens believe that their leaders and systems are corrupt, it decreases public participation and investment, further stifling economic growth. Corruption in Pakistan has become a self-perpetuating cycle that is difficult to break. Each scandal that goes unpunished normalizes corruption, setting a precedent that it's a viable means to wealth, rather than a high-risk crime. Corruption not only drained resources, but also eroded trust in the economic system. All these factors culminated in bringing a nation to its knees. How did it all lead to talks of bankruptcy? The journey to Pakistan's current economic plight is a complex tapestry woven from various threads of mismanagement, political instability, and global economic pressures. Each factor, as explored in previous scenes, did not act in isolation, but in a troubling synergy that magnified the country's vulnerabilities. Let's start with the recent failed negotiations with international lenders. Pakistan, over the years, has become heavily reliant on foreign loans to bolster its economy, and manage its substantial public debt. However, as political turmoil escalated and confidence in the government's stability waned, these crucial negotiations hit a deadlock. Lenders, wary of the increasing risk, hesitated, demanding more stringent reforms and transparency than the already beleaguered government could guarantee. Concurrently, the value of the Pakistani rupee took a nosedive. A plummeting currency not only inflates the cost of imports but also escalates the debt burden when it's denominated in foreign currencies. This devaluation led to inflation, squeezing the common man's ability to afford basic necessities and diminishing public confidence in the economy's management. In response to these crises, the government implemented several emergency economic measures. These included slashing public spending and imposing new taxes. However, these measures, though necessary, were not well received by the populace, leading to widespread discontent and further destabilizing the already fragile political environment. Moreover, these economic strategies, while aimed at immediate relief, did not address the systemic issues such as chronic corruption, inefficient bureaucracy, and lack of long-term economic planning. The focus remained on short-term firefighting rather than sustainable economic reform. As Pakistan stands on the precipice, the road to recovery remains uncertain but necessary. The intertwining of economic mismanagement, political instability, and adverse global economic conditions has indeed brought Pakistan to a point where the path forward is not just about economic recalibration, but also about restoring faith in its political and economic systems. The journey ahead is arduous, calling for unwavering resolve and visionary leadership to steer the nation back toward stability and prosperity.